My name is Joe Liniak, and I'm one of the financial service banking partners here at Dorsey. And hopefully this is going to be kind of an entertaining presentation on two subjects, GSE reform and blockchain developments. And let me just introduce our panelists. Immediately next to me is Jake Kleiner, who is from US Bank. And as you can probably tell, he's going to be speaking about blockchain because he's a millennial and he understands this stuff. And he works very closely as a member of the blockchain and distributed ledger practice at US Bank and is embedded in all of their development, et cetera, and is willing to share with us what they're doing and how they're doing, and more importantly, what do they think about this thing called blockchain. Next to him is my partner, Tom Kelly, who is the co-head of the finance and restructuring practice here at Dorsey. And among other things, Tom is an expert in warehouse lending for residential and commercial mortgages and has a long, long history in terms of dealing with financing of mortgages and dealing with our friends, the GSEs. The way we're going to go about it today is we're going to first talk about GSE reform, and then Jake and I are going to provide some thoughts about blockchain and where that is going, not from the perspective of some of the crazy people who are walking around saying blockchain is the beginning and end of the world or the beginning of a new world, but rather how it fits into a bank's perspective on what banks do. So having said that, Tom.
All right. Joe, if you could move the brief history of housing finance in the United States. Before the 1930s, mortgage lending was done by private entities, banks, and savings and loans, and there was no federal involvement. Home loans were relatively short-term back there. The 30-year mortgage was not a norm, and so they required frequent rollovers and renewals, which during the 30s didn't happen. So during the Depression, the government started to get involved in the housing finance business. The Federal Housing Association, FHA, started to guarantee mortgages for certain borrowers who were deemed deserving. After World War II, the VA, in a very large way, got involved in guaranteeing mortgages for veterans. And the original Fannie Mae was created, which was an actual federal government agency, to create a market for buying mortgages from banks and S&Ls. Later on, Freddie Mac was created to basically buy loans from the S&Ls. It was support for the S&L industry. And that was the state of play until the late 1960s, when Lyndon Johnson had a big problem with the deficit. Of course, not compared to what we have today, but a big problem for them with the deficit, and decided to fix it by getting Fannie Mae off the government's balance sheet. So what happened was Fannie Mae was privatized. Freddie Mac was modified to permit it to act as a direct competitor for Fannie Mae. Ginnie Mae was created to securitize government guaranteed loans, the purpose of the original Fannie Mae. And through the 70s, we went through with these GSEs playing an increasing role in the industry, but still primarily loans were made by banks and S&Ls. Then came the S&L crisis, and that led to the emergence of private mortgage companies. And by private mortgage companies, I mean mortgage companies that are not affiliated with a bank or savings and loan. In fact, a number of them were spun off during the S&L crisis from failed S&Ls. This is how I got my start in the mortgage business, was working on some buyouts of mortgage companies from our friends at the Resolution Trust Corporation. And so you had the emergence of what is called the originate to sell model, which is basically the primary way that mortgage loans are done today. They're done, the mortgage company that originates the loan, for the most part, does not intend to keep it. intends to sell it off. It originates the loan with borrowed money and then sells it to Fannie or Freddie, or if it's a government guaranteed loan, securitizes it through Ginnie and makes its profit on the mortgage trade. During the 1980s, you had the beginnings of private securitization structures. For those who have read Liar's Poker, you're familiar with that. And in the 90s, Congress and the Clinton administration began to impose affordable housing guidelines on the GSEs, thus moving the affordable housing mission out of being something that FHA was the primary focus of and making it all of the government entities involved in the mortgage market. In 1999, Gramm-Leach-Bliley was passed, and the relevant issue for the mortgage market was that it declared derivatives to be out of bounds for all regulators. And about the same time, you started to see the emergence of a credit default swap market on mortgage-backed securities, which all contributed to the next 7 years, 2000 to 2007, which was the big party. Those were the years I was in the mortgage business. 2000 to 2006 were the actual party years. 2007 is when we paid the price. The mortgage market started to fall apart in late 2006 as home prices, which according to the experts would always go up, started to go down. And it turned out that all of those subprime loans that were, also valuable and were sure to be repaid when housing prices were going up 10% a year, didn't look so sure to get repaid once housing prices were dropping, since the borrowers largely couldn't afford them. During that time, the subprime originators failed and aggregators failed. And at this point, then Chairman Bernanke said this was a problem that was contained within the subprime industry, but he turned out to be wrong. In July of 2007, Bear Stearns had 2 mortgage funds that collapsed. In August, there was a major liquidity event in the US and Euro markets, and the LIBOR spread over comparable treasuries increased by 196 basis points, almost 2%. And that's like from 0.2% to 2.2%. So it basically, the LIBOR market was no longer viewed as being similarly risk-free to the Treasury market. During October through December, large banks reported huge mortgage-related losses caused by them having to write down mortgage securities investments because the quality of the underlying mortgages was not very good anymore. That brought us to 2008. I won't spend a lot of time on this slide because most of us are old enough to remember that. But Bear Stearns collapsed in March, and Bear Stearns was a very large player in the mortgage business. In July, Congress enacted a new statute to govern Fannie Mae and Freddie Mac and created a new agency, the Federal Housing Finance Agency, to regulate Fannie and Freddie, and gave FHFA the power to put them into conservatorship or receivership. During this time, Fannie and Freddie knew they had problems, and they were out trying to recapitalize themselves by peddling their preferred stock to a lot of the banks and mortgage companies that were members, which turned out to be really bad because on September 7th, they were put into conservatorship by the FHFA, and the value of that stock pretty much disappeared. So let's move forward. I won't spend time on the rest of it because it's not directly relevant to mortgages. What's happened since the crisis is the securitization market for non-conforming mortgage loans, that means mortgage loans that are not eligible for sale to Fannie Mae or Freddie Mac or securitizable by Ginnie Mae, has pretty much disappeared. There have been some small transactions done, but most jumbo A loans have been held on balance sheet by banks rather than securitized, and subprime loans have become very rare and hard to get. The government chipped into this development by defining a QM, or qualifying mortgage, to be a mortgage that fit into a fairly tight box, which for practical purposes, was defined as anything that's eligible for Fannie Mae or Freddie Mac. The government further piled on by creating the CFPB, which has adopted a number of revisions to the consumer protection regulations, which have created problems for the mortgage industry, although they've largely been worked through. Finally, Fannie and Freddie have been working together on creating a common securitization platform, which will be very important later on in the presentation. So, what are Fannie Mae and Freddie Mac? They're very large entities. You can see here the assets and the liabilities of each. And they have very, very little capital. The common equity of Fannie is 18/100ths of its assets. Freddie is relatively well capitalized at 21/100ths of its assets.
Tom, one of the things that you may want to note here is when the government took over Fannie and Freddie, they came up with a pretty weird funding mechanism whereby all of the profits that came out of Fannie and Freddie after they made their investment went in not in the form of repaying the investment, but rather in the form of dividends. And when you calculate the amount of profits that have come out of Fannie and Freddie since the time of the government bailout, they have more than paid themselves back and yet still owe several $100 billion to the government because it was never an offset.
And that's the senior preferred stock that's shown on this slide, which is treated as a liability by both companies and is owned by the federal government. So in terms of actual capital, Fannie and Freddie essentially don't have any. We'll move forward past this slide. So the talk this year has turned to whether now is the time to actually do something about fixing the part of the financial system that caused the meltdown 11 years ago. And there's a number of players who are involved in the process. Within the administration, the key players are Secretary Mnuchin, who, among other things, made hundreds of millions of dollars by buying IndyMac Bank from the FDIC in 2009 and selling it in 2015, and Director of the FHFA, Mark Calabria, who was in his prior life the Director of Financial Regulation Studies at the Cato Institute. Those of you who aren't familiar with Cato, it's the leading national libertarian think tank, and shall we simply say that in that role, Mr. Calabria advocated a substantial reduction in the federal government's role in housing finance, and he had to repudiate some of those views in order to get confirmed to be the head of the FHFA. The bottom line is that the administration does not at this point appear interested in moving towards a really free market approach to mortgage finance. It's more inclined, as you'll see later, to modify the existing status quo in a way that theoretically won't lead to the same problems, but might lead to different ones. In Congress, the key players are Senator Crapo of Idaho, who's the head of the Senate Banking Committee, and he appears to be genuinely interested in moving housing finance reform legislation in this Congress. The Democrats, of course, took control of the House, and the chairman of the House Financial Services Committee is now Representative Maxine Waters. And today, including with something that came out today that Joe sent to me, she's made it clear that her focus is going to be on criticizing the banking industry and expanding affordable housing goals and subsidies, which, as you'll see, is inconsistent with what the administration and the Senate are trying to do. There are also the usual outside players. The Mortgage Bankers Association in particular has put forward an extensive proposal for reforming the system, which we'll get to in a minute. The American Bankers Association has been involved. The credit unions have been involved. Consumer advocates, of course, have been involved. And there are also some Wall Street interests that are involved in this process. The investment banks make a lot of money underwriting securities for Fannie Mae and Freddie Mac. And they do not want to see a system that doesn't preserve that gravy train come into play. And the other Wall Street interest is the hedge funds, which have bought Fannie Mae and Freddie Mac preferred stock. They feel the government has badly mistreated them by taking all the profits rather than allowing the profits to stay with the companies so that there'd be some value to their preferred stock investments. And they will push very hard to get some kind of relief through this process, although I doubt they'll succeed.
And so far have lost in the courts.
Yes, so far they've lost in the courts because, believe it or not, the government gets to make the rules. They stepped in and bailed out Fannie and Freddie, and they don't see why they should give them back to the old owners. I find it hard to argue with the government's logic on that. The MBA proposals, which I've outlined in the next few slides, are designed to bring a much higher level of risk-bearing private capital into the mortgage system, enhance the stability of the mortgage system by expanding from the duopoly of Fannie Mae and Freddie Mac to a multiple guarantor system, protect the taxpayers and consumers with all kinds of regulations, because you could never imagine the taxpayers having to bail out a financial institution that was heavily regulated, could you? Turning to the next slide, a major objective of the MBA is to ensure that mortgage lenders of all sizes and business models have equal access to the secondary market. This basically means they want to protect their own membership. Shouldn't be a surprise to anyone, but as you'll see, this becomes a major theme of the proposals that are on the table now. They also talk about improving service and performance in the secondary market by having multiple guarantors compete, minimize disruption during the transition to the new system by preserving what works in the current system, and meeting the needs of the full continuum of households, from families requiring the most directly subsidized affordable rental homes to those served by the completely private jumbo single-family lending market. That last one is they know they need Democratic votes to get anything done. If you want to summarize the MBA's proposals, I would summarize it as saying, if you like your mortgage company, you can keep your mortgage company. The Senate outline, which Senator Crapo has put forward, is really not terribly different from the MBA's proposals in terms of its substance. It also provides for guarantors of mortgage-backed securities, starting with Fannie Mae and Freddie Mac, and expanding to include others who decide they want to go into this business. Uses what is called the utility model, which basically means these guarantors will be monolines and they will have regulated rates of return and regulated pricing. Senator Crapo has also provided in his bill, which tracks the MBA's bill, that regulated financial institutions will not be permitted to either be or to own these mortgage guarantors. So these will be outside of the banking system. The FHFA will become the chartering agency for these entities and will be in charge of regulating and supervising them, establishing prudential standards, and approving their pricing models. Under the Senate outline, Ginnie Mae would have an expanded role because it would become the securitization vehicle not just for government-guaranteed mortgage loans as it is today, but also for mortgage loans that are guaranteed by these guarantors. That means that the guarantee of mortgage-backed securities would be the full faith and credit of the federal government, as Ginnie Mae securities are today, rather than the implicit guarantee that has been involved with Fannie and Freddie for the last 35 years. There'll be a mortgage insurance fund, which will be somewhat like the FDIC, but not. And essentially, in the end of the day, the Treasury will still stand behind the mortgage-backed securities market, but there'll be a lot of different ways in which they try to minimize the risk that'll ever be called on. The Senate outline also deals with affordable housing, and here it departs from what the MBA has talked about, because it wants to see the current affordable housing goals and duty to serve requirements replaced with a new market access fund, which will provide grants, loans, and credit enhancement to address homeownership and rental housing needs. And these funds would be, the Housing Trust Fund and other funds would be funded by an annual assessment of 10 basis points of the total annual volume guaranteed by the Fannie Mae successor, the Freddie Mac successor, and any other private guarantors that were approved to participate in this system. The White House came out at the end of March with a memorandum. The memorandum directed the Secretary of Treasury to develop a plan of both administrative and legislative reforms to achieve the following housing reform goals: ending the conservatorship, facilitating competition, establishing regulation that safeguards their safety and soundness of the GSEs, and providing that the federal government is properly compensated for any explicit or implicit support it provides, or baseball, hot dogs, apple pie, and Chevrolet. The White House memorandum was very clear that it's looking for both legislative reforms and administrative reforms. And the importance of that, of course, is that the administrative reforms, to the extent that they are identified, can be done without going through the legislative process, without the involvement of Congress. The Secretary of Housing and Urban Development was also, Joe, if you could flip the screen, was also charged with developing a plan for administrative and legislative reforms to the FHA and VA programs and Ginnie Mae. And part of that charge is to attempt to assure that FHA and Ginnie Mae assume primary responsibility for providing housing finance support to low and moderate income families. In other words, the White House's reform proposals will take the pressure off of Fannie Mae and Freddie Mac to provide affordable housing subsidies through their mortgage products, which would be a major change and is consistent with the Senate outline. The House plan, well, there isn't one. Nothing has come out of the House other than some statements, and the statements made by the House leadership on the Financial Services Committee are all focused on preserving the status quo, including the affordable housing subsidies that are built into the system. Representative Waters made a statement on January 16th, shortly after she assumed the gavel, that that's going to be her focus in any affordable, in any housing finance reform bill. And Representative Meeks, who chairs the subcommittee that will be involved, was even more direct. He said that any housing finance reform plan must maintain a government backstop for the mortgage system, modernize credit scores, an issue that hasn't been discussed much before, but involves changing the credit scoring system in a way that advances the affordable housing objectives, and provides troubled homeowners with a way to avoid foreclosure, which the government did a lot of after 2008, but those programs have all pretty much expired. So where does that leave us? Where do we go from here? There's sufficient common ground among the industry, the administration, and the Senate to get a deal done. The House will want to move those proposals significantly to the left. And in my view, there's very little likelihood that the House and the Senate will come together on any kind of reform bill in 2019 or 2020. The one exception to that is if the Treasury plan comes forward with a very aggressive approach to reduce the federal role in housing finance by basically winding up Fannie and Freddie, then the House will need to act with the Senate to preserve the current system, which is what the Senate proposal does. I don't think that's very likely to happen. I don't think that's an issue that the president will see any political benefit from. And so I suspect that what we're going to see is 2 more years of conservatorships with some tweaking around the edges on the administrative side and maybe some very small legislative changes, but nothing to materially address the dysfunctionality of the housing finance system. So, any questions?
We just covered a lot of territory. One of the things that is interesting here, and something to keep your eye on, is who ends up either owning or operating the common securitization platform that's being built by Fannie and Freddie. And there's a definite feeling that though that thing that's being built will end up being the crown jewels of the secondary mortgage market. And while the concept is that, well, let's give it over to Ginnie Mae to operate, for those of you that have had the pleasure of never having your telephone calls returned by Ginnie Mae, they are somewhat antiquated in their capabilities, and it is certainly possible that even though they may technically own it, they could theoretically then contract it out to be run by Fannie and Freddie, which puts us back in the same position. But that is a very, very important concept not to lose track of. I think the other one that is also important, as Tom mentioned, is the housing goals. For those of you who are in banks, you probably understand the tension that was created over many years where, in order to meet housing goals, Fannie and Freddie were desperately trying to buy loans from banks and other entities in order to meet their housing goals, but those same loans qualified for Community Reinvestment Act credit, and very difficult to do, requiring some very, very creative schemes at the end of the year to be able for Fannie and Freddie to be able to meet the housing goals, and de-linking them through effectively what is going to be some form of mortgage tax through the guarantor program that's being proposed is probably a healthy thing in that it will allow housing advocates to be able to have a fund by which affordable housing can be financed, as opposed to using the origination capabilities of the GSEs in order to promote those goals.
And if there aren't any questions, then we will turn to blockchain.
Blockchain is kind of fun. It was originally a phenomenon, and now it's become mainstream. 5 years ago, anyone making a presentation regarding financial services had to say CFPB 20 or 30 times in the presentation in order to be relevant. And nowadays, you got to say blockchain several times because that's what gives you the imprimatur and nihil obstat. One of the things that, while cryptocurrency has gone wild, it's gone wild internationally, and probably one of your children is probably either originating and issuing tokens in cryptocurrency. They certainly probably own them. But surprisingly, the developments in the area on the bank side have been surprisingly slow, and we're going to be talking about this in a moment. And importantly, and I think this is to our benefit, the regulators other than the SEC have been actually hands-off in terms of their approach to blockchain vis-a-vis the banking system, and that's a very, very good thing. It allows for experimentation and inquiry without the safety and soundness folks coming down and saying, what exactly are you doing? And I think that perspectives are really kind of important here. We're talking today about blockchain versus the application that is resident on the blockchain. And a lot of times that concept is confused by folks. You know, you certainly got cryptocurrency and you've got all sorts of, shimmering little jewels where someone says, I've got a great idea, it's now worth $1 billion, please give me money. And there's a lot of folks out there that think that that's the way it should work. The government, I think, is viewing blockchain as a incremental technology and not as a predominant application. And Jake is going to be explaining the view from his perch, doing the work and trying to figure out how it can help the banks. And I guess at the end of the day, is it really just a sophisticated Excel spreadsheet which has got some capabilities to it that may help us, as opposed to some of the crazies that are sitting back saying, it is the second coming and really kind of important. You can probably tell where I stand on this. So what we're going to do is we're going to talk about the observations regarding the bank industry's perspective about the value and potential value of blockchain. We're going to look at the federal government's approach after that, and then we're going to look and see what the state government's somewhat warped and crazy approach is in terms of trying to legislate blockchain of all things. So with that, I'm going to turn it over to Jake.
Perfect. Thanks, Joe. So when we start talking about distributed ledger within the context of banking, we do start with Bitcoin, which seems a little weird because we don't do anything with respect to Bitcoin. We tell people every day we don't do anything with respect to Bitcoin, and despite all that, my family still thinks I work with Bitcoin. But it's important because that's actually where we started. 5 years ago, our chief innovation officer came to my colleague, Chris Swanson, and said, this Bitcoin thing's getting a ton of hype. We need to figure it out, understand whether it's going to kill banking, be completely irrelevant, or sort of somewhere in between. So we started researching Bitcoin, cryptocurrency, and blockchain. And we quickly found out that Bitcoin has several properties that make it very, very difficult to be used by banks. In short, it's kind of antithetical to the concept of know your customer, anti-money laundering. You can actually trace a Bitcoin back to the beginning of time when it was first created, but you trace it using a public address, which doesn't necessarily correspond with a known person. So I might be able to tell that I own a Bitcoin, and before that Joe did, and before that Tom did, and before that some other address did, but I have no idea who that address belongs to or what they were doing with the Bitcoin. So Tom can convincingly say, I'm using this for legal and legitimate purposes, but that's not really the standard of banks when it comes to anti-money laundering or know your customer.
To be clear, I have never owned any Bitcoin. I don't understand any of this. And my fondest hope is that I retire before understanding this becomes necessary to my work.
And I'm not accusing Tom of laundering money. So anyways, we quickly found out that Bitcoin was sort of not tenable with the bank's core principles. But when we zoomed out a couple steps and thought about what Bitcoin is really doing, it's providing a way to track a piece of data, because that's all a Bitcoin is. It's a string of data, and it's being transferred from person to person. And when that gets transferred, if I want to send a Bitcoin to Joe, I basically submit my transaction to the group of Bitcoin node participants, people running a copy of the software. And they all look at the transaction, and they can say, based on the code and based on the protocol they're running, yes, Jake has a valid Bitcoin. Jake's address has a valid Bitcoin. It is the Bitcoin he wants to send. He wants to send it to Joe. Joe has a valid address. Let's effect this transaction automatically. And what that does is that means when I want to send a Bitcoin, I don't have to trust the network or a central party to clear that payment. I know that if it's a valid transaction, it will make its way to Joe. Joe doesn't have to trust me. He knows that he's only going to get the Bitcoin if the network verifies that it's valid. And no one in the network has to trust either of us. They can rely on the protocol, on the software, to effect transactions, rather than having a clearinghouse or a central third party, or a bunch of KYC, which is what makes it problematic to banks, but good for the purpose of Bitcoin, of fast money movement. And so we abstracted that out and said, a few of those principles, the fact that it's immutable, the fact that you don't necessarily need a central third party to provide confirmations, the fact that it's auditable. So in Bitcoin's case, I mentioned I can't necessarily trace who owned the Bitcoin back to the beginning of time, but I can trace it, and that's on a public network. So we could create a closed network with all of us, and we could all be participants, and we could be known, and then I could trace where a Bitcoin was at every step of the process. So we abstracted out what the Bitcoin network's actually doing and said, to us, distributed ledger is a way for parties who don't fully trust each other to maintain consensus about the existence of a set of facts and how those facts are changing over time, i.e. transactions. So in the Bitcoin network, anyone can join. We don't necessarily know who they are. They're sending Bitcoin back and forth. They don't trust each other at all. You probably don't even know the vast, vast majority of people on the Bitcoin network. In a lot of bank transactions, we mostly trust each other. We mostly trust our counterparties. We trust Wells Fargo, Citi, B of A, all those participants, but not enough to have them operate everything on our books. We're not going to say, here, take our billions and billions of dollars of funds. Let us know how it all shakes out. Give us back what we deserve, and we'll just call it good at the end of the day. So we mostly trust each other, but not fully. So there still is value in having a way to exchange data about facts. In our cases, it's positions in a certain type of asset, positions in a loan, the status of trade documentation, and then how those facts are changing over time. Because the reality is, in the banking industry, we do a lot of stuff via email, via phone call, via fax machine, and that lends itself to a lot of manual time and effort, a lot of errors that require reconciliation, and a lot of time and cost. So we think of it as a way to potentially improve the workflow that happens between companies in the banking industry or in adjacent industries that involve banking. So all that said, what do I do and what do we do at US Bank? So there are three different sort of core things that we do as an innovation team and that the distributed ledger practice does. And the blockchain practice is myself and Chris Swanson on the business side, and then 6 development team members that help us test and pilot use cases. So we basically do a bunch of research, make sure we're up to date on what's happening in the space, what's happening in adjacent spaces, meeting with new technology providers to ensure that we are sort of at the cutting edge of what's potentially happening in banking or in adjacent spaces. We do internal business development. So believe it or not, among the 70,000 plus US Bank employees, not every one of them is super well versed in blockchain yet. We're getting there. We're a lot further than we were a couple years ago. But at the same time, I'm not an expert on any one area of the bank necessarily. So a lot of back and forth with internal parties, helping them better understand Bitcoin and blockchain, and them helping me better understand asset-based securitization. And then program management, which is basically, we've done some research, we've reached out to a business line, we think there's potential for blockchain to improve the process of loan syndications and reconciling positions in a large chunk of debt. So now we're going to work with our developers to build out a test case of that alongside other bank participants and see if we can show that that would actually work in the real world. So this slide's just a list of the stuff we've explored. And all of this has included at least one test. So think of it as a low fidelity proof of technology where we build a simple app. If we demoed an application for you on the blockchain, it would be super disappointing versus what you're probably expecting because it just looks like a very basic software application. There's nothing magic about it. It's just that on the back end, each individual bank, each individual participant is running that same protocol, same common copy of the software with the same set of rules. So for example, in a syndicated loan, if we have a loan, if we're a lead agent on a loan that Target wanted to borrow, and they have $1 billion outstanding, and then the interest rate is changing by 1/4 point, and they want to prepay $50 million of the loan, you can imagine between the agent bank, 5, 6, 7 other lenders, a bunch of buy-side investors, potentially corporate trustee participants. It's one loan, but there are quickly 3, 4 dozen participants involved in the loan. And so those 2 simple tweaks take a ton of phone calls, faxes, back and forth, potential errors, reconciliation. And so that's an example of the type of rules that can be baked into this system where I was sending Joe a Bitcoin, I broadcast the transaction, everyone says, yes, based on the rules of the system, you have a valid address, he has a valid address, you haven't spent that Bitcoin, transaction's good to go. In a syndicated loan, the lead agent could submit those changes and they could say, yes, Target has at least $50 million outstanding on their loan, so they can make this prepayment. It doesn't go against the terms and covenants of the loan. The quarter basis point increase makes sense because it's based on LIBOR and the rate just went up last week. So we're good to go, and we're going to affect this automatically on June 30th at the end of the quarter. So it truly is just taking workflows that exist for the most part today and potentially adding some efficiency in cases where parties don't fully trust each other, where there's manual reconciliation, where there's a problem with auditability, or there's just simply a problem in transferring information between a bunch of parties in an efficient, error-free, and automated manner.
Well, before we go on, I've read a lot about cross-border remittances, and in the past, one of the criticisms of that, if you send money just about anywhere and you're taking it outside of, say, your bank and having to send it to another bank or whatever, it can take, frankly, an extremely long period of time in order to get a verification. Is that something that may be in the offing?
Yeah, so that's definitely a potential use case. It's something we're actively exploring. I think when we think about cross-border remittances in particular, there are sort of two components to the efficiency gains here. One is the workflow piece. And in the case of international payments, remittances, that's like a SWIFT, so a SWIFT replacement, where you can send a more efficient message. You can potentially do it on a near real-time basis, where instead of me sending a payment through my bank, them sending it to a correspondent bank, them sending it to the end destination, and then receiving the messaging back and finding out, hours or potentially days later whether a payment succeeded or failed, you can sort of get all the participants to agree on each step in the status on a real-time or near real-time basis. So that messaging component improves the error rates, decreases the error rates, improves the time that it takes for the transaction to go through, and relieves a lot of potentially manual processes involved in that. And then there's the settlement piece too. So once you have the messaging down pat, you need to actually get the money to the end participant. And that's something that blockchain's further away from solving on the enterprise side. You could use a cryptocurrency, but again, banks by and large don't have interest in doing that. And so there are a bunch of use cases in early exploration around, folks may have seen JP Morgan announced they're coming out with a coin that enables people to settle actual money real time, but only amongst JP participants. So that settlement concept is just very hard. It's really difficult to get a broad network of banks agreeing on something that basically looks like digital cash and using that at scale while still maintaining all the KYC, AML, and other regulatory pieces we have. So I think very much near term with respect to international payments messaging and improvements on that. But I'd say much longer before the current system of, sending a physical wire, ACH, or using Nostro, Vostro accounts and netting out between correspondence banks. That won't change for a longer time in our view.
Yes, sir.
So when we're, as lawyers, drafting a syndicated credit agreement, are we working with the computer programming people? I mean, is this, how invasive is this going to be in the actual loan deal process?
Yep, so the hardcore blockchain evangelists who think that this is going to absolutely change the world in every single respect would tell you that you guys are out of a job in a decade because the code is going to become the law and the programmers will just be able to write everything in. Obviously, that's super far from realistic in any sense of the word. And so I think that legal documentation and the process behind that probably isn't going to meaningfully change in the near to medium term. I think when we think about smart contracts, which is what we call the automated pieces of the protocol that allow something to happen, allow a change to be made, allow a transaction to happen, I think it's going to be pretty simple for the foreseeable future. Things like interest rate changes, revolver draws, prepayments. And so There's probably going to be some consultation up front with legal teams and professionals to decide what those parameters are as you're building out an application. And then at the end of the day, you're probably going to have like 30 different scenarios that are already built in that you just plug values into. And then you'll have exception handling done by humans, which will be similar to the way all handling is done by humans today.
Well, it's comforting to know that we're about a decade away from losing our jobs.
Minimum.
In my case, I'm retiring in 5, so I don't really care about this.
It's 2 of us.
Yeah, Tom's there with me. Let's talk a little bit, and then we can take some questions, because this is just a fascinating area. And I want to talk a little bit about what government has been doing, particularly vis-a-vis banks, and to some extent the wider scale world. And you've got banking, and you've got the Federal Reserve, you've got the FDIC, the OCC. It's kind of the flavor of the month. Everybody's got to be able to say, yeah, we're doing something for it. You've got some real involvement with the SEC and the CFTC in terms of what they've been doing. And then you've got the law enforcement folks who are very, very present in this area, and they are not going to be backing down, and we'll talk a little bit about why that is the case. In the SEC side, almost everything from their perspective is a security. And it's really a very strident position that they have adopted, and they've taken that based upon the Howey test for what a security is. If you remember, about 2 years ago, suddenly everyone was buying cryptocurrency. Hundreds of millions of dollars were being made, and it was being done in the United States. And people said, well, we really don't have to do a securities offering. It's just there. And the SEC came back very strongly and said, look, the Howey test for what a security is, if there's an investment of money with an expectation of profits, an investment in a common enterprise being affected through either a promoter or for a third party, you've got a security. And they have been advancing that in a very, very strange manner, in that a lot of folks were saying, well, okay, fine, we will do a funding over here. We will register the securities, and then we will separately issue tokens. And the SEC seems to be objecting to that. And their argument is that by issuing a token or some form of value, you are creating what they deem to be an ecosystem, and therefore, behind the scenes, you're really doing investment, and then the Howey test works. And it really is kind of a extreme position, because folks have been trying to fix this problem so that we don't have all of the fundraising taking place outside the United States. And yet the SEC is very, very strong on this point. And it's really a test for the wary. Walking into the SEC and saying, this is what we want to do, you end up getting somewhat confounded by being told, well, we don't really care. We think that's still a securities offering, and you've got to either register the what's being offered, or you have to have an exemption. The CFTC, it's a little bit easier. For those of you that are not Dodd-Frank aficionados, they amended the Commodities Act as part of Dodd-Frank. Practically everything now is a commodity, everything. Hopefully your children, but not necessarily. But you can trade anything, and it's a commodity. It's a lot easier, though, because there, if you will, it's a self-declaration in terms of what you're trading on, and so you've got far more flexibility on the CFTC side to be able to be dealing in cryptocurrencies in particular. But and that's because they cannot simply barge in. They've been making noises, but still clearly have been letting the SEC to be taking the lead on that. The Prudential banking regulators, what's been very, very good here is they haven't been doing a whole lot. When you take a look at the examination and supervision manuals, they thankfully have not done an addendum on cryptocurrencies and blockchain and so forth. They're really letting the banks experiment with it, and that's good. And they when you talk to them, they realize that, and I think this is correctly, stated that blockchain is a tool. And what is a bank but the original fintech company? That's what banks do. We try to do, we move money as efficiently as possible. We use the technology, and these fintech companies are Johnny-come-latelys in terms of what a fintech company really is. The banks were the beginnings of it and are still far ahead of that. This is not to say, though, that everybody wants a piece of the action, and just about all the regulators have come up with their own innovation departments to help people innovate, and it's kind of nice. And you can look at it, and everyone's got some folks that are doing some nice things. Actually, the OCC is doing a very, very good job in terms of innovation, and you can chat with them. And they've got these so-called sandboxes, which are, in my view, totally ridiculous, because yes, we are going to exempt you from having to comply with the law, and why should you be exempted as opposed to complying with what the banks have got to do? It doesn't hold together, but nevertheless, they talk a pretty good story, and that is out there. FinCEN and the state regulators on money transmission laws, this is where the majority of the issues come up. In terms of being a money transmitter, when you're dealing with cryptocurrency, there's actually a very, very easy registration process at the FinCEN level. But at the state level, you've got money transmission laws, and it is a nightmare to go through that, because you've got to get a license in just about every state in which you do business. But the part that is, I think, really kind of unusual when you talk to the aficionados of blockchain and cryptocurrency, et cetera, they say, well, hey, this is really safe, this is fine, et cetera. And yet, remember the 7 degrees of Kevin Bacon? Well, you go back about 2 degrees, and you probably have got an illegal transaction taking place dealing with money laundering that still exists using cryptocurrency. And as much as folks would like to say it's not taking place, it is taking place. Everyone's probably got a story where some organization was held hostage, where their computers were attacked, and you had to go buy cryptocurrency in order to be able to ransom your computer systems. But it really has not moved very, very far away from that. It's getting a lot better, but it's still there, and it's a definite source of concern to the regulatory authorities, especially the law enforcement folks. Now, on the state side, they've kind of gone off the deep end in a somewhat harmless way, and yet it's pretty, well, frankly, stupid. All you folks are probably familiar with UITA and e-sign. Something can be in electronic form, and it's going to be enforceable. A signature electronic form is going to be enforceable. Well, the regulators have, in several states, are coming up with statutes dealing with an expansion of UITA and e-sign. And frankly, when you read it, you sit back and say, why are you guys doing this? It doesn't make any sense whatsoever. And at the back of behind the curtain, what they're doing is they're trying to promote their state as being technologically advanced, asking people to put their buildings and their research facilities at a particular state. And yet, some of the provisions that they've adopted are silly. Some of them are stupid. And I don't think they necessarily accomplish anything, but everyone is copycatting each other. The one thing which I wanted to point out to you how really silly it can get, this is the Arizona statute, and Arizona has gotten a lot of press. They've actually been successful in having some fintech companies come to see them. And their blockchain technology definition, the last sentence here is, the data on the ledger is protected with cryptocurrency, is immutable and auditable, and provides an uncensored truth. I've got an undergraduate degree in theology, and I have no idea what that means. But that's in the statute now. And every time you make a change like this, you are running the risk of coming up with a problem in which you don't meet the definition and is what you're trying to accomplish by saying, for example, a smart contract is enforceable, and it may not necessarily make the definition under the statute. Or in this case of a blockchain, well, I'm going to challenge you because I think it is not an uncensored truth. And this is certainly true of some of these other states where they've amended the Electronic Transaction Act, which is generally going to be the UETA or the e-sign Act. In some cases, they're sweetening the pot by saying that taxing blockchain technology is inappropriate, the same way that interstate transactions initially were not till the Supreme Court overruled it. And again, some of them are good, some of them are bad, and most of them are completely useless. However, it is something that as these applications roll out, it may be required that instead of saying we know what the answer is, we may have to go back and look at state surveys to see whether or not we've got some crazy bumps in the road in order to be able to make sure that what we're doing in terms of this technology works. We are right at the end of the session. We have time for a couple of questions, and please ask Jake because he knows everything about this stuff. Yes, sir.
As U.S. Bank is looking at distributed ledger technology, are you considering just, instead of linking with U.S. Or with Wells and Bank of America, are you considering just looking at internal applications where you can streamline and improve efficiencies within the bank itself, at least as a starting point to expand and improve concept and getting operational experience?
Yep. Yeah, so that's a great question. Have we spent time exploring internal-only applications of blockchain, so reconciling positions or transactions within U.S. Bank? We have spent quite a bit of time exploring that possibility. We haven't found a lot of use cases that are slam dunks in terms of moving those things forward internally. A big part of this is a good portion of blockchain's value is using the protocol, using the rules, and eliminating the need for trust and reconciliation between parties. Hypothetically, if we're within U.S. Bank's four walls, hopefully we all trust each other. And I guess I would argue if we were building all of our infrastructure from the ground up, we should probably never use distributed ledger for anything internally because you can use APIs and internal servers and things like that to quickly communicate and reconcile positions. Now, the reality is all big banks have grown via size and via geography by a bunch of acquisitions of other banks, and no large company has a perfect set of internal systems. So there are cases where between different business lines, between different geographies, we have different systems talking to each other in different ways, or different parties involved in similar pieces of a transaction. And so there's potential value there, but I think by and large, we've found that the bar to move forward with blockchain's a little bit higher with respect to internal applications, just because the sort of need to trust the counterparty is not as heightened because we all trust each other internally. Now, the flip side is the network's a lot easier to build because building networks of banks is very, very hard and time consuming. But to date, nothing internally that we've felt the need to sort of urgently drive forward towards commercialization.
I'd like to thank Jake for participating and for Tom. I hope this has been entertaining for you folks, and we're going to have a short reception here. And thank you very much for attending today. Thank you.